So I shall start out with some definitional points, which will be tragic and disappointing, but I have to do this, and I thought it probably best that I get away the disappointing bits to start with. Let me start, first of all, by laying suitable acknowledgements that our temperatures are new well known, and the people remain the spiritual and custodian guardians of this land and continue to practice their values, languages, belief and knowledge, and I pay my respects to their elders past, present, and of course emerging as well. Let me start with venture capital. As always with these things, if you work with things on a day-to-day basis, you're apt to take things for granted, including the nuances and the subtleties associated with them. But I think from the point of view of establishing what I mean by the influence of X on Y, it is a good idea to try and at least to ring fence what I mean by X and what I mean by Y. So let me start with venture capital. There's been various definitions of venture capital. Here are some. NASDAQ, the US technology exchange, would be a good place to start, I would have thought. So as you can see there, investment, generally speaking, in a startup business. So something from scratch, of course, which has excellent growth prospects and therefore will be plenty valuable down the road, but doesn't have access to capital markets. And I think I'm sympathetic to that kind of argument. So can't raise bonds and has extreme difficulty raising debt from a conventional bank organization, and may indeed lack internal equity in terms of what the founders can put together compared to the capital expenditure that is required. I used to be a venture capitalist, so I have some sympathy with this. The OECD has suggested this one, a subset of the equity industry. Now, this is very important because making a distinction between private equity and venture capital is crucial here, as we will see in relation to agriculture and agribusiness and so forth. So their view is that it is a subset of the private equity industry, and indeed many organizations find that they effectively subsidize their venture capital operations from their private equity operations. Does that sound familiar to anybody from the agriculture space as well? In many cases that is true, and that is the reason for that is that although you can all think of some spectacular examples of venture capital success, for every one success you can find a dozen or more that are not, and therefore the returns have to be spectacular in order to justify the existence of the industry as a whole. It is interesting to see, from my point of view, looking at an academic definition from now over 20 years ago, from the time when I was operating in the space, how little has changed, at least in terms of definitions. We're pretty clear now about what venture capital means. For me, I always go for the capital markets. Can this business absorb debt? If it can't absorb debt, and let's exclude venture debt, because that's really venture capital structured as debt for tax reasons. So let's exclude that. But essentially, if it can't absorb debt, and debt is generally speaking cheaper than equity in most countries, not Nigeria, but generally, and therefore you would prefer to take on debt if you could, rather than taking on venture capital. Venture capital in some senses is a last resort in that sense. So the distinction remains critical, but there is also plenty of evidence that venture capital works very successfully, and sadly and ironically, a good article on how well it's done in Ukraine, for example. So that it's successful, that's what it is, and it also works in a series of stages now. So you have your first round at a certain valuation, your seed round, and then your next round at a large, hopefully larger valuation. Sometimes you get down rounds, but next one and next one and next one. I've just been doing work on internal auditing of venture capital fund investments, and you can see very much that process actually works. And often venture capital companies will invest and then get out if they traditionally operate at seed level to be replaced by another one who traditionally operates at A, and so forth. So it's a complex and difficult business, and it's hard to make money out of, even with tax credits given by governments. Oh, can't see the slides, someone's saying online.
Oh, yeah. Well, we need it separately.
Okay, I'm sorry.
Where is this working? Which system is it? Teams? Or is it Teams? So is it working from here?
It's working, yeah, it's working off the line computer.
Is it from here?
Maybe it's not being shared.
So this is what I will need to.
Sorry.
It's all right.
So that computer needs to
They said they can hear me, but they can't see the slides.
Okay, but I'm trying to see what is the system on. Okay.
Oh, there we are.
Okay. So what we need to do?
Share.
Where is
Click on
it? Just
share.
looking for it. Where is
You're
it?
right in the middle.
Middle.
Right in the
Ah,
middle.
yeah. Okay. Do this. Share, and then go back to.
That's it.
No, that's not enough because now we need to go back to the
PowerPoint.
PowerPoint over here. There we are, and then go into there. And that should work.
Oh,
That should work.
Thank you.
And those of you who are online, is it working now? Can you see the screen?
Yes, it's working.
Oh, thank you very much indeed. Sorry I wasn't swift enough to do that.
Julian, just drag that little.
Oh, no, just click on hide. Click on hide right there. Yeah, that should be fine. There it is.
Thank you. Thanks very much indeed. Okay, so this one I think probably is much more familiar in this environment. This one's much more familiar for you. Definitions of agriculture, of course. Agriculture itself is rarely a recipient of venture capital funding for pretty obvious reasons. There are some exceptions. ARE-UWA is a marketplace, which you wouldn't be surprised about to receive money, but agriculture itself, being well able to take debt and not necessarily producing the kind of stellar returns that VCs would look for, is not a terribly suitable place for venture capital. Hence my point about the tragic disappointment. Agribusiness more widely, however, your farm to fork definition, which is the classic 1957 definition, now I think probably worth broadening, if I could slip in a quick suggestion here. So including things like urban agriculture, vertical farming, agribusiness, all this kind of stuff, that potentially is much more suitable for venture capital. And of course, the boundary, as I say, between wholesale and retail has become fuzzy. It's because we've got online marketplaces and so forth, which, like ARE-UWA, even if it's dealing with land, is a very good potential destination for venture capital. Ag tech in particular is entirely suitable for VC funding. I mean, it's a technical sector, potentially one of great value. And ag tech has been defined, and this has been defined by the USSC as this, which are enabled by patented technology into the agriculture value chain. AgFunder, which is the largest organization operating in this space globally, a wonderful group of people, says they call ag food tech, they talk about as the small but growing segment of the startup and venture capital universe that's aiming to improve or disrupt the global food and agriculture industry. Their definition is intentionally broad, going from crops right the way through to livestock, biotech, property management systems, biomaterials, and of course meat alternatives, as you know, all the way up to tech platforms for restaurants, grocers, online deliveries, and at-home cooking, and all the rest of it. And it's a striking point because agriculture and farmland is the top primary industry destination for capital in Australia, excluding private equity funds focused entirely on natural resources, and actually accounts for a third of the total capital raised in unlisted infrastructure and natural resources over the past year or so. And yet we've got this situation, and I'm going to point later on to how it stands in relation to Australia. So those are our two definitions. That's venture capital on the one hand, that's where it's likely to go in this space on the other. So what's the evidence? Well, part of the problem with assembling the evidence is there are a number of different sources of information for this, which is what I spent a fair bit of time working for this. There's PitchBook, there's Crunchbase, and then there's AgFunder. And they're all slightly different definitions and so forth. This one is PitchBook. AgFunder say their data is more complete. They have data partners around the world. And in general, though, in terms of trend, having looked at the various trends, this is pretty much what we've seen. So we have seen this acceleration. And if you then go back and you look at what people said in the past about investment around 2012, there's a lady called Nicola Kerslake from Real Estate Junkie in the States bemoaning the fact only 10 years ago that she was getting calls twice a week from agricultural startups and others who wanted money and no venture capitalist was willing to invest. And there was a lot of prediction, a lot of excitement and suggesting that there was going to be money going into sustainable agriculture, but absolutely nothing was happening. Since then, as you can see, With the exception of what's happened this year, to which I will return, there's been a large and significant increase. And it's that significant increase that I want to delve into and try to explain to some extent. The evidence provides some indication of where the sectors have been. This one is in a sort of zoom position on this, an overall view on this. And you can see the broad sectors in which the money is going. So you've seen, starting from a position where there was very little on ag, finance and e-commerce, we've now seen a great deal more of those starting to emerge. We've also seen a fair degree of involvement in indoor farming as well. So that's been a recipient. And of course, as you expect, precision agriculture. So we've moved, as you can see, into a different space during the course of this time. This gives a more detailed approach on where it's all come from. Global data, which is also extremely helpful, thank you, global data, have provided an indication about where the money has actually come from in terms of millions of investment. And these are the kinds of things where the investment has gone in the ag tech space. In the view of analysts looking at this, using data from Crunchbase and others, there's been a view that some of the ag-food tech categories, like delivery or restaurant software, have been very popular destinations for venture capital for a long time. But now we're seeing a much more diverse array of startups across the entire food supply chain. And in 2021, for example, which is obviously the last year which we've got data for, about a third went for food, feed and fuel companies, about just under a third for crop protection and production companies, over a quarter for value chain and logistics companies, 9% for digital agriculture, and only 2% for animal health and nutrition companies. New funding for indoor farming in particular, and plant-based meat, which is the real star of the show, is driving this. About 34% or so, it's about a third of the dollars went to startups focusing on commercializing technology using synthetic biology. That's the real area of interest. Just under a fifth went to virtual marketplaces, about 10% or a bit more on internet-connected sensors, about the same amount on gene editing, again, some on material science, computer vision, and data sciences of one variety or another. Now, I'm not going to push into discussing the sectors directly, because that's not my main focus here. My main focus is in what is driving all of these things. Now, it is possible, of course, that different factors are driving each of the subsectors, and that's worth considering. But at this point, I'm trying to take an overall view. All right, some of this is absolutely familiar and completely understandable. Clearly, growing global population is putting much more focus on agriculture and feeding the world and so forth. So that's an issue. And there is general recognition that without more technology, we're going to have some difficulty doing that. And that's a recognition everywhere. So that's an underlying and main driver. But that's also a driver for consumer factors and vehicles and a whole lot of other things as well. Secondly, again, startlingly obvious, climate change issues, global warming, and the increasing commitment by governments to attaining these targets in respect and constraints on natural resources and so forth, land and water in particular, are also making sure that everyone gets focused on trying to use technological solutions, as we have achieved as a human race over the past thousands of years. These problems have been overcome by technical means, thinking back to Malthus and all the other debates in the past. And so it's logical that we would turn in that direction. Thirdly, again, very logical and very well known, changing consumer tastes. On the one hand, an increasing demand for meat in emerging markets, proteinization and so forth. On the other, and I'm sure all of us have seen this in the shops around here, the rise of commercially available meat substitutes at affordable prices and with relatively attractive culinary characteristics. So a change in taste, plus government trying to drive for anti-obesity moves, health moves, improving health, all of these things all point to the need for increased technology in the food space and the agriculture space, plus cutting down on waste. I mean, the government itself recognises that we have an appalling problem with waste. In developing countries, I'm familiar with what's happening in Pakistan and Indonesia and elsewhere, and we have even worse positions with respect to waste. So there's plenty of opportunity. If you even cut that down, if you devise techniques to cut that down, they would pay for themselves many, many times over. So there's good reason to do those things. And so, whilst Kerslake said there was a perception 10 years ago that there was a willingness and an interest in transferring, 10 years on, Burswood Taylor, who works for AgFunder, who is the director of research at AgFunder, observes that it's still probably the least digitalized industry in the world. So plenty of opportunities. So those are primary drivers. I've tried to organize my thoughts in this by talking about primary drivers and secondary drivers. These are the underlying factors that are pushing in that direction. Secondary driver, I would suggest the fact that venture capital companies themselves have been now increasingly pushed to start thinking about their own footprint, their own ESG position, for example, what they themselves are doing about sustainability. And this has been pushed in significant measure by the actions of large private equity organizations, traditionally villains in the world of investment, but in fact now coming out and making quite strong pronouncements in favor of ESG. And you're all aware, of course, about the rise of ESG reporting, the need for the concern about the way that organizations are increasingly joining the UN PRI, also the super funds leading the way in terms of potential investment. So there's a supply-driven push in that direction as well. Then I would say the gap between renewables and agtech is diminishing. Plenty of interest in renewables, and there's a feedback mechanism there, and traceability, another example. So there's plenty of regulatory pressure pushing organizations generally, larger agricultural organizations and others, to be interested in the kind of technological solutions that can be offered by the kind of companies that venture capital is investing in. Finally, of course, the pandemic itself encouraged a greater interest in the supply chain, which again allows some potential space for venture capital investment along the system. Perhaps this claim is a little extreme, that it was ag-food entrepreneurs that kept the whole thing going, but it's a measure of how far we've come that such a claim could even be made in the first place. So I put those down as a secondary set of drivers that would underlie. Thirdly, I would suggest the structure of the VC industry itself is changing. And a lot of money is coming in from what we might describe as non-traditional sources. And by traditional in this sense, I mean small venture capital outfits of one variety or another. So private equity firms, hedge firms, mutual funds, a lot of non-traditional types heading into VC and becoming much more entrenched in the marketplace. Many agriculture companies in particular, they've had VC divisions for years, but there's growth in the number of corporates that are committing to this space. I think that's particularly important. So of the top, AgFunder said that of the top 25 publicly traded agriculture companies around the world in revenue, they've identified last year, I think, that just over half of those firms now have some sort of corporate venture program, which they didn't have 10 years ago. Syngenta Ventures, for example, funds 2 to 4 companies annually and gets about 200 on its radar scan. Venture capital, a lot of their time is taken winnowing down the total down to those that you spend investing in. And the suggestion has been that this is a new way to growth for themselves when their top-down strategic initiatives might not be delivering the kind of growth that they want to see. And other organizations, it's interesting, AgFunder was saying themselves that capital rushed into upstream innovations, those closest to the farm, in fact, and often those that are the most capital, time and resource intensity, robotics, remote sensing, biotechnology, and so forth. All of those elements. So plenty of examples that VC has become part of corporate strategy, and indeed organizations like Louis Dreyfus, Cargill, and a whole number of others, BACF, there are a large number of these organizations that have got involved. So I think this suggests that the way that the industry is changing, the fact that this is corporate venturing, suggests that more of these organizations are getting involved and being more comfortable in the venture capital space as a larger organization, given that there are significant organizations in this space anyway, in the agriculture and chemical production and so forth, makes it almost inevitable that they would lean towards investing in those things for which they have some degree of synergy. So I would suggest that's another secondary driver. An outburst of relevant technology. Global data supply this. Thank you very much again, global data. A whole series of them. You could turn them up and have a look at them. You've got but a whole range of these things. And of course, once you get technological innovations happening in any of these spaces, then it is extremely likely that you will see more examples of relevant technology. So it becomes, when you've got companies like California-based Pivot Bio, taking nitrogen from the air and making it available for plants, raising $430 million through a Series D. When you've got Chicago's Nature Fund, developer of nutritional vegan protein from a microbe, $350 million Series C. California-based Appel Sciences, developing plant-derived shelf life extension technologies, $250 million Series E. Anything you can see in common about these organizations? Anyone? Just one thing strikes me about them. I'll come back to that point in a minute. Another reciprocal driver. Specialist agriculture investment institutions have now developed. If you want to get involved in a new space as a VC, you look for expertise, you look for information, you look for data, you look for support. And if you don't have those, then you're going to back off to a significant degree. Tech's had it for 30, 40 years. Agribusiness, agri-tech is beginning to do this. And academic research, this research was done for Egypt, but suggests that industry experience is important from the point of view of VCs. VCs do tend to have industry experience for obvious reasons. Private equity, traditionally more financial experience. VC, more traditionally product and sector experience. And so that if you didn't have people with that sector experience, you weren't likely to get people investing in the ag space, but now you do. And so people traditionally, they ignored industries that weren't familiar. Technology, biotech was just about the limit where they would go. And so this is what has been said in the past. Particularly applies here, by the way. Suggest points about where people could and could not invest. So AgFunder has now grown and become something of an institutional body. I've seen them grow, make more publications, regularly get involved in the space. We'll talk about where they stand right now a bit later on. But they've acted as a VC themselves, but they've taken the view that if you want to be a successful VC in this space, one of the things you need to do is to build institutional competence. And I had a superb example about that yesterday in a different sector of an organization that operated geographically differently because of a family connection there. Institutions matter, and if you get them built up in an area, then you're going to promote the space. In Australia, it's been a little bit different. Consultancy organizations have set up to try to disperse information, but it's not the same as AgFunder operating in the US and the UK. And less powerful from that point of view of connections. None of this would matter, of course, at all, and wouldn't succeed if the venture capitalists themselves didn't manage to obtain decent returns from what they do. And in the past, they were very skeptical. Those VCs who did look at the sector 10 years ago were skeptical that suitable returns could be obtained. I think they thought generally that the time frame was much longer, as many climate skeptics did as well. That we could be talking about this space, but only in the 2030s and the 2040s, not in the kind of short time frame, the 5 years or so, that matters to venture capitalists. We need to be in and out in a 5-year time frame. We can't be sitting around as a long-term investor because the growth curve of the company will start to fall off. And once that happens, then we need to be out and on into another investment. So it's got to be something happening in the next 5 years for us to be interested. Otherwise, we just won't succeed. AgFunder, which publicly reports, now says tracking 23% IRR. Well, a diversified venture capital portfolio that returns 23% IRR, well, I'm in, thank you. That looks good to me. You do need $100,000 US to invest, mind you. probably reasonably. But that's not too bad. That's quite a low level. It's almost at the retail level, almost. And that 75% of rounds it's participated in were oversubscribed. So they've got more money coming in than they can do, have had more money coming in than they can do anything with. Now, on top of this, we have seen some absolutely stellar returns from the real stars. And the real stars, Impossible Foods, Beyond Meat, and so forth, including IPOs in other sectors like Blue River and others, showing that it really is possible for this sector to deliver not necessarily an Amazon at this point, but certainly something that looks like it and has the possibility of being able to deliver something in the region of the kinds of returns that lastminute.com or Body Shop or any of the others got delivered. So there's evidence. We're even starting to see some ETFs, some diversification in the area as well as SPACs that are now able to range across the field and invest in any agtech areas. Now, none of that's any good, of course, unless you've got liquidity, unless you can get out. And of course, that becomes a self-fulfilling prophecy. The more venture capitalists who get involved in the space, the more Series Bs there are willing to take from Series As, the more Series Cs willing to take from Series Bs, and so forth. So it becomes very positive. And the more that there are conglomerates and others who are interested, whether they're John Deere or Bayer or any of the others, the more opportunities there are for IPOs, and IPOs have been going gangbusters over the past 2 years, particularly in 2021, which was a global record. There's plenty of opportunity for exits and therefore reasons to be excited. The consequence of this is that we have seen dedicated ag funds get created. And again, from the institutional point of view, I think that matters. So in India alone now, look at all those impact funds, the rise of socially conscious impact funds. Where would you turn as an impact fund? Where would you turn as a socially conscious investor? Why not to some form of technology in the agricultural space as well? Omnivore, the most well-known agribusiness fund manager, and it's interesting to see that they have been pushed and helped by international donor investment of one variety or another, which has now finally recognized that one of the things to do is not just to give grants, but to invest in organizations that will actually deliver products and services. Of course, not all of them will work. Not all of them work in commercial venture capital, but at least you are starting to think about these things. And you can see Omnivore, second fund closed on digital platforms, third fund now launched in April 22, focused on early stage technology. All the classic elements of this, aiming to raise a reasonable sum of money, somewhere in the region of $100 million US. You can't raise 5, 6, 7, 800 million for any individual fund. You wouldn't find sufficient targets for it to be able to invest in. That's always the problem. That's why these funds end up being oversubscribed. Thought I'd give a comparison to how things sit here. We have lots of ag tech venture capital investors, over 100, but, and there was a report written a few years ago now, investment is very, very modest in this space in Australia. And I flagged this up almost by using the word warning. 1 in 50, 1/50th per capita. And it's very circumscribed, as that report from the University of Sydney in 2018 flagged up the warnings. And that was 4 years ago. Since then, things have accelerated hugely. Tenacious is the most well-known. It's well-established private equity and venture capital specialists at this relatively small amount of money, and to some extent, a drag or drain off of the money towards renewable energy, which has been, of course, an immense Australian success story. So if you're going to put your money in venture capital anywhere, the temptation in Australian terms is to put it in renewable energy sources where we are a global superpower, rather than putting it into agribusiness. And you can see the Clean Energy Finance Corporation, which is a slightly curious investor in the ag tech space globally, has put money behind this. That's strikingly Australian. But they're looking at seed and Series A. They're starting to make some investments, and these are the investments that they have made. All public, all clear, not the actual returns. Those are private, but at least the investments themselves are known and how much. And now about 60% deployed, hopefully seeing more. So that's the position here. I wouldn't have space to describe the position in the United States I would be here for a very long time talking about all the investments that have been made in the United States. There are 3,129 ag tech startups in the US reported most recently, compared to more than 500 in the UK and 700 in India. About 72% or so of ag tech deals between 2012 and 22 took place in the United States. Yes, there has been growth in other areas. You can see that we are starting to move towards this, but the dominant players in the technological space in the next 10 years are the ones that get created in the maelstrom of this 10 years, as we've seen with Amazon, which is, of course, in case anyone hadn't noticed, a US company. Now, this seems to me, and when it says Americas, you can more or less read for that the United States of America. What it means is that by comparison to a very nascent ag tech industry in Australia and elsewhere in the world, stymied by a lack of capital investment, commitments and saying that ag tech in this country and other developing countries will be core to achieving growth in agricultural production and profitability, and that depends on machine learning and artificial intelligence and robotics and a whole lot of other stuff, is actually going to translate as we pay license fees to US companies. That's the way it's going to work now. It's pretty clear. Now, that may be a very beneficial relationship. It may result in increased yields, great performance, but it is nonetheless striking that the way it's going to work is driven out of US tech companies. It didn't have to be this way, but this is the way that it's ended up being. Let me bring my thoughts to a conclusion on this. It's become something of a virtuous circle. As I've persistently stressed, the willingness by VCs to make these seed, Series A, B, and C investments encourages others to participate. The fact that they can achieve exits, good returns and so forth, means that this has now become an established segment of the venture capital industry. And I really think AgFunder deserves some significant credit for that. They have been very consistent, and they've got excellent staff retention, and they've had excellent marketing and branding, and they've worked really hard in this field. And there have been others too. People in the venture capital reporting industry, in PitchBook and in Global Data and elsewhere. Obviously, all of them partly motivated, I think, by a sense of moral responsibility towards the world and a sense of ESG consciousness, as well as excitement over the different technologies that have been developing. All of them are keen that this should remain. And so I think we have achieved a real victory globally in this space, generally. But there remain significant concerns, particularly here in Australia, about whether the model works, whether we can make enough money in terms of returns in a domestic context to make that actually work. Ultimately, as with technology, we will end up being a victim of our own success. We will have our giants created, and that success itself is looking more distant. That view here, expressed by the founder of AgTech back in 2019, over a 5 to 6 year horizon, which means in a couple of years' time, let's remember, agricultural robots will become very, very viable. They are not yet, not on a commercial scale, not generally. And because we are replacing labor with capital, that will mean, of course, reducing costs, but it will also mean, of course, that we have less employment. And that's a factor that governments will be concerned about all around the world, and means that there is a tension between developing VC in agriculture and the broader political issues that surround employment in agriculture going forward. And I think that probably is a real reason which slows this up. Next point. This year, valuations of these companies, along with the rest of the VC sector, have fallen. And when you get a down in valuations, it could be regarded, maybe even should be regarded, as an excellent opportunity for venture capitalists to step in and make investments. But if your exit valuation, your publicly traded companies or your Series D and E have fallen in value, that means your glide path from where you are now gets substantially attenuated and your potential reductions exist. And venture capitalists would have to be very brave, as with anyone, to invest in a downturn. Arguably, people should very much invest in a downturn. You could look back on the history of all sorts of investments to see that's the case, but it's difficult to do. That suggests to me that we have reached the end of that rising period. It will leave a legacy, and I've touched on what that legacy, I think, actually means. A fundamental transformation in the nature of venture capital investment to create a new subsector, which will now, hopefully, and I think definitely, will be with us going forward. But a substantial reinforcement yet again in productivity between developing and developed countries. That's the legacy of this. And that's something which the venture capitalists putting their money into technological startups and elsewhere in the United States are reluctant to take on board. If you're replacing labour with capital, and that becomes extremely inexpensive capital, that's going to mean that the productivity gap is going to widen even further. There's got to be research done on that going forward as to the degree to which automation, robotics and sensoring and so forth is increasing returns, but I believe that evidence is already there that those returns have increased and the gap is widening, not decreasing. It's also likely to produce international winners. And at the moment, those winners look like being the meat substitute companies. They're big, they're really, really big now and getting bigger. They're still loss-making, but hey, so is Tesla. So I don't think that should particularly trouble us. If they continue to have access to capital and they continue to have people willing to buy their products, then I think they stand a very good chance of success. We should, however, recognize that something of our appearances might be a little bit deceptive, and that we are seeing a decline now in the overall numbers. And I think my concluding point really is this: we can't have it both ways. We can't say, on the one hand, we are delighted that venture capital is now including agribusiness and agtech as an established portion of its domain, and at the same time demand that this curve goes on increasing. Because venture capital doesn't work like that. It works in cycles. We've seen a huge expansion of venture capital over the past, the biggest expansion in venture capital the world has ever seen, that has been somehow lost in the multitude of other stories that have happened around the world. We've seen more venture capital investment put in over the past 5 years than the entire history of venture capital up until now. That could not continue. And so we're now starting to see that decline globally. And so I think it's almost inevitable, as we see the statistics coming in already for 2022, that there will be a coming off the boil, at the very least, of venture capital investment and possibly a significant decline. And that is going to be accompanied, I suspect, by at least a levelling off and probably a decline in venture capital investment in agriculture and agribusiness. But that should not deter us from going forward, and it should not stop us from recognising that there's been a very considerable achievement made over the past 10 years. And I, for one, very much look forward to those results coming forward, as we're already seeing on our shelves and in our fields and in our rivers and elsewhere. And I think there's a lot more to be said and a lot more to come from this story over the next 10 years. Thanks very much. Questions?
Thanks, Julian, for a very exciting and refreshing topic. So it's open. Yeah.
Thanks, Julian. That was fascinating. I noticed that you had a graph there of venture capital in agriculture going out slowly and then jumping in 2021.
Yeah.
I'm wondering, in your view, is that what's going on there? Is that just a sort of a continuation of the steady acceleration, or is there a pandemic effect or something
It's all of those things.
that suddenly hit in 2021?
It's all of those things. The venture capital itself accelerated tremendously. So it's rising tide lifting all boats, but also individual deals can distort venture capital statistics across the board. So that's another factor that influences it. But yes, supply chain investments during the pandemic and so forth, and also corporate investment happening during 2021 as well. All of those factors all coming together. But the evidence from 2022 is that it was a one-off and will not be repeated at quite the same level going forward, which is understandable.
So could you talk us through your perception of how, the effects the pandemic had and how that washed through?
Yes, it seems that, first of all, it seemed that initially there was a concern about whether this would be a long-term effect and that we need to think about this long. I think also it led to a degree of reflection during 2020 on the part of organisations, my understanding about what they were going to do and what they were comfortable with. Once the pattern became more or less established, then there was definitely an interest in the supply chain and investing in those supply chain products and just a perceptible move away from field and upstream investments towards midstream and supply. But that's now, I think, sort of solidified, and we'll have to see from 2022 what the division of areas of responsibility actually were. Venture capital traditionally has been very, very reluctant to operate outside relatively limited geographical borders. And one of the things I can say about the pandemic is that it encouraged a degree of entrepreneurial geography, as it were, that there was a willingness to think about activities outside, because if you weren't going to do that, you weren't going to go anywhere. You had to be prepared to take those kinds of new forms of risk, because everyone was doing it. So that, I think, is a very positive legacy that the pandemic has left us with. More than that, I'm a little bit reluctant to say until I've got the balancing figures from 2022 to compare to what actually happens in 2021.
Well, it seems to me that you could invest in supply chains without investing in technological innovation.
Yes, and
you could just invest in infrastructure using established technologies.
Yes.
So what's coming? What are people excited about in the supply chain?
Blockchain,
area?
essentially. It all revolves around that. It revolves around creating trust tokens, which of course would be highly appropriate in the context of a world in which it's very difficult to check and verify physically. And a lot of the interest in the supply chain revolved around that. And now there's a continuing debate about whether ICOs and otherwise will continue to be part of the venture capital and exit legacy.
So that's largely about quality, isn't it?
Yes.
Rather than about
guaranteeing quality. Well, yes, because no venture capital investment itself in the short term is going to be able to guarantee anybody's supply.
Yeah.
That's why I'm not entirely happy with that comment about
the guarantee of supply was the big, so in the early days of the pandemic, that's what everyone was freaking out about.
Yes, and I don't think you're going to be able. I don't think you're going to be able to achieve that with a small scale venture capital investment. A small scale venture capital investment may result in a marketplace or something down the road, 10 years from now, which will be able to do that. But in the short term, no, and certainly not now the pandemic has ended. No. Yeah. That would be my take on this. But for more detail on that, I'd have to get more granular and get into the individual investments themselves.
Okay,
but thanks for that.
So we could answer the question.
I will.
Right?
Yes.
Ross.
Oh.
You need to go see the end of it, isn't it?
See more.
See more.
See the last one there? It's got see more.
So Ross is asking about the implications for US versus China.
Yes.
Yeah.
I think strategically it is likely to put the US in a better position. That seems clear. Thank you for the question very much. It puts the US in a better position than we perhaps suspect in this regard. In terms of whether China is able to take those pieces of technology on board, that will depend on diplomatic considerations, I think, rather than anything else. I'm inclined to think that it's probably a positive indicator in relation to US-Chinese down the road, because if those US companies are going to get the markets that they want, if they're going to expand and become global, all those things, they will have to engage with China, and China likewise will want to get access to that technology as much as it can going forward. What we don't have good access to, and I would love to have, is the degree to which China itself has been putting money into venture capital in this space, and that's a very valuable implication. I'm sorry not to be more clear about that, but I think that would be my overall assessment. But it's going to be dominated by much broader considerations as to where we go with US-China. It's not going to be driven by this. But if things start to get better, then certainly it will benefit those companies that are involved.
Ron, and then Steve.
Thanks, Julian. I'm just wondering, perhaps going a little bit beyond what you presented, given the context we are facing in terms of environmental conservation and all these sort of things, and the disparity in productivity between developed and developing countries, as you alluded, do you foresee that there will be some sort of FDI flows through these sort of innovations into the areas where the productivity can be enhanced going forward? Because we need to feed the world.
I think it's a brilliant point. I think to break it down, my view is that we traditionally think in terms of agricultural productivity and enhancing that productivity through, as you say, FDI transfer. But what if you substitute that agricultural productivity with a manufactured product that is less expensive and you can still feed? That, I think, is where we are beginning to go. So I can see, starting with the middle class, but eventually coming forward, I can see manufactured, as it were, pellet food. The type that I'm very happy to consume myself, being delivered.
Chicken pellets.
Impossible foods, burgers, and so forth, being delivered en masse and being used to feed. And that does not involve FDI. And it certainly doesn't necessarily even involve local production, although it may. Production under license, I think, might be the closest you would get to that kind of exercise. Where technology doesn't actually transfer, but you get a local manufacturing plant owned by whoever it happens to be operating, and that's then used to. That's the way I'm inclined. So it's a transformation not only in what's going to happen, but also in our way of thinking about the process. When we don't think about technological transfer in developing countries in the car manufacturing industry, for example, we just think about them importing cars. But when we talk about agriculture, of course, we have your view about transferring and getting them to it. Maybe.
The problem is there's so many of them who rely on it. 70% of Indians work in agriculture.
So I'm flagging up. Maybe, certainly beyond my working, or even physical lifetime, this becomes an issue. We already import, of course, but in other countries, we already import substantial quantities, even of basic foodstuffs, let alone processed foodstuffs. It's not like we're known for countries like the United Kingdom, for example, to supply themselves agriculturally largely from imports. So it wouldn't be unknown. It's just a question of how those imports would work and what the technology that would sit behind those imports. Now, to be fair, those developing countries and the policy makers in those countries are aware of these issues and they are pushing back. Only today, I was reading that insect manufacturing company in India has just received $17 million to develop insect production in country to fight back against these issues. But the chances of that succeeding in the really large areas of production, I think, looking at that quantity of money that's going in the US direction, the pointers seem to me to suggest that this is the way it's likely to go. There will be exceptions, and there will certainly be, in terms of agricultural production, yes, there will be technological transfer that will be happening, but it will all be under license. Whether that counts in the sense of FDI, in your sense of the word FDI, I'm less convinced. The other problem, of course, sorry, it's such a fascinating point. The other point is that if you are going to act as the German investment fund or whatever, and you're going to put money into a company which is going to be committed to supplying health, you're still going to make money out of that company. And you're definitely not, as the pharmaceutical companies, of course, discover, you're not going to succeed in that way by simply saying, right, we put a couple of billion into this, but now it's all free for you to be able to consume. And I can see that the agri-tech area is going to be a little bit like that going forward, on a smaller scale than pharmaceuticals, but in that direction.
Steve?
I've got a small question and a big question. The small question is that at the end you said the VC phenomenon is, it's going down. It's going to be,
Cyclical.
it's
cyclical.
cyclical.
Cyclical, not structurally, absolutely
Okay.
not. But it's cyclical, and inevitably it is. So,
Okay,
as is IPO markets. IPO markets are going down this year as well, and a number of other areas. So capitalism works like that.
Okay,
So,
but the technological impetus through AI and agriculture, all this sort of thing, is that going to follow it, or is it going to continue? And if it tries to continue, then where's the money going to come from? Or if there's a constraint in money, then that too is going to. That's the small question.
Can I answer that first?
Yeah.
So what tends to happen is the technology gets put inside firms which are funded. So specific technologies now properly funded will get advanced because there is the runway to be able to consume that money and develop that technology. They may not be the best technologies. There have been plenty of examples in the past of where technology has not been the best, but because it's better funded, it ends up coming to market. So without analysing and being able to be really sure, there will always be entrepreneurs who say, if only I'd been funded, I'd be better off than X or Y. It's a very difficult exercise to conclude. What I think we can say is that for the most part now, the big technologies that are going to come in this space are the ones that are being funded now. If you haven't been funded now, it's going to be more difficult, not impossible, but more difficult for you to get funded over the next 5 years. And because it's going to take 5 years to get into serial production at least, and probably 10 years before you get into really scale production, if you want to see what the technological boundaries are going to be of the ag-tech space 10 years from now, probably look to those organizations that are well funded in the same way that you can look back onto Impossible Foods and Beyond It and so forth 5, 6, 7 years ago when I was writing, 2018, 4 years ago when I was writing International Agribusiness, and I was saying this is likely where it's going to go, this is the interest in the area. Now you see 4 or 5 years down the road, that's exactly what's happening. And there will be differences in time frame, but that's essentially what we're looking at now. You can take a snapshot and project it forward. Because you do, as you said, you need the money to be able to develop. The big question.
Okay. I want to refer to the fact that you said, well, referring to the fact that employment might be at stake, that these investments to high tech, biological, biochemists or whatever, biotech information, and the fact that there will be winners of big companies. So putting all this together, okay, this is in a broad sense information technology or very sophisticated equipment that's going to now modify agriculture, and to me makes me think that perhaps for the first time we're going to go into increasing returns to scale. So increasing returns to scale is going to be the norm, which means all our agriculture economics textbooks can be thrown away.
I don't know about so much,
or anyway, become marginal. But what I'm trying to say here is that it's going to change the rules of the game, and it's going to tend to concentrate, well, I don't know, the power, capital, and so on. So that's going to have impacts on disparities between developing and developed countries, between people get employment and so on. What's your view on this?
I think I'm going to give my personal opinion here. I would say yes. If you look at the history of aviation in the early years, you have hundreds of different companies producing aeroplanes. And then within 20 or 30 years, you end up with relatively few. If you look at car manufacturing, you start with lots and lots of different cars and different types. I mean, people even thinking about batteries, who would think about that? Of course, internal combustion bound to be better. And eventually you end up with relatively few. And it seems that almost any industry that aims at an international focus is likely to go that way. And that's why I'm fascinated now constantly to look at the plant-based section in the supermarket. Where was this made? With whose technology was it being made? That's now the interesting, fascinating question for me. And also, hopefully around the world, also looking at different countries, how far has that penetration worked into different sectors and so forth. We're only at the beginning of this process. It could be 20, 30 years, but it looks as if that's the process. And that to some extent, there's going to be a competition between that and traditional agriculture going forward. That looks to be. I wouldn't be suggesting that everyone's going to be able to, even 2030, that's certainly not.
Depends on the fight back. Oh, yeah.
Yes, and it also depends on global policy in this regard. These are big geopolitical issues that donors and other countries will be concerned about. And also on trade negotiations, and saying also relationships, diplomatic relationships with China, and a whole number of other big, lots of moving parts in this issue. But just zooming in on the technology, it does look as if this is beginning to. Yes, and very exciting, I find it too. And I think I would just flag this in terms of policy. If any policymakers were to listen to this, this is the issue now. It's not just about agricultural production at smallholder level and those kinds of things. It's also about how you feed people using mass production, using vertical farms, and using urban agriculture, and a whole lot of other issues. And we need to have that balance and that perception and that regulation of the industry and the profits that it makes that I think will be critical going forward.
Okay, so it's almost 12, so we will stop on that. Thank you again, Julian.